All right, so when you hear life insurance, what pops into your head first?
Yeah.
It's probably, protecting your family if something happens to you.
Right. Protecting loved ones.
That's the classic image. But we've been digging into some sources lately, and
Yeah.
life insurance, it can do way more than that. It's like this multi-tool for individuals, businesses even.
It really is.
And you're here because you want the smart version, right?
Yeah.
No time wasted. So we're going to make this deep dive thorough and efficient.
Yeah. And we're going way beyond just that basic survivor protection.
Mm-hmm.
Today, we're really unpacking the many uses of life insurance based on some pretty detailed material we've got.
Yeah.
Our goal is to show you how life insurance fits into your personal finances, how businesses use it, and even how it works as part of employee benefits. We want to give you that clear understanding without drowning you in technical jargon.
Perfect. So the stuff we're looking at breaks these uses down into a few main parts. First is figuring out how much coverage you actually need, which sounds more complicated than you'd think.
It is.
Then is how individuals use life insurance in their own lives. Then we go into how businesses use it. And finally, how it works in those employee benefit plans.
Sounds good.
So let's jump into that first part. Figuring out how much life insurance someone really needs.
Okay.
Seems like a simple question, but there's a whole process behind it, right?
There is. It's crucial to get that right. Whether you're an individual planning for your family or a business trying to protect themselves if they lose a key person. And the material we've got outlines a 5-step planning process. It starts with gathering information, not just basic stuff like your age and health, but all that crucial financial info, income, assets, pensions, the whole picture.
Right, so like a full financial inventory.
Exactly. Then step 2 is identifying and prioritizing what you want the insurance to do. Like, is it for your kids' education, leaving a legacy? I mean, make sure the business keeps running.
Right.
Then step 3 is analyzing your current financial condition. What are you working with? Step 4 is actually making the plan and putting it into action based on all that info.
Okay.
And step 5, this one often gets missed, is periodic review. Life changes. Your insurance needs probably will too. And one thing they stress is thinking about lost income. Could your family have to sell assets at a bad time if that income's gone?
That's a tough one to think about, but important.
It is.
Now they talk about 2 main ways to figure out the right amount: human life value approach and needs approach.
Yes.
Those seem pretty different.
They're each focused on different things.
Yeah.
The human life value approach is all about your potential earnings.
Okay.
It's trying to calculate what you'd earn over your lifetime minus your own expenses.
Yeah.
So imagine what income you'll bring home between now and retirement. You take that yearly income, subtract stuff like taxes and living costs, then multiply that by how many working years you have left. But then you have to consider the present value of that future income, because money today is worth more than the same amount later. So it's putting a dollar figure on your earning power to make sure your family's covered if that income stream disappears.
It makes sense to think about it that way. But what are the downsides of that approach?
Well, the material points out that it's mainly focused on that income replacement. It doesn't totally account for everything else someone provides besides just money, like unpaid caregiving or emotional support.
Right.
The needs approach takes a much wider view. It looks at specific financial goals.
Okay.
So not just income, but things like needing to pay for college, having an emergency fund, leaving money to loved ones, or making sure a surviving spouse has enough for retirement. It's a really comprehensive look.
So it's more about making sure those specific future needs are met.
Exactly. And with this approach, you need to look at everyone's age, income, and health history, the whole family, to get the complete picture. Then you figure out how much capital you need for things like funeral costs, debts, and those future goals we talked about. Then you take into account what assets you already have: savings, existing life insurance, pensions, even potential Social Security benefits. Well, got to remember that blackout period where a surviving spouse might not get those payments right away.
Yeah, that blackout period is definitely something to consider.
It is. Then you subtract those existing assets from what you think you'll need, and that gives you a more tailored idea of how much extra life insurance you might want.
Okay, so the needs approach feels much more like a full-on financial plan,
It really is.
taking into account those future obligations and what you already have. But the source mentions some other maybe simpler ways people estimate their needs too, right?
They do. There's the multiple earnings method, which is pretty simple. You just multiply your current salary by a number like 5 or 10.
Yep.
The idea is that's roughly how many years of income your family might need to replace. Then there's the interest-only method. where you look at how much insurance you'd need so the interest alone could cover your family's living expenses without even touching the principal.
Interesting.
And the single needs method
Mhm.
focuses on just one specific need, like paying off the mortgage or a kid's college.
Okay, and what about the capital needs analysis? That sounds like a super detailed needs
You
approach.
got it. It's basically that, but very granular.
Okay.
You break down immediate cash needs like final expenses, medical bills, probate costs, paying off debts, setting up an emergency fund education, maybe even death taxes. And then you factor in ongoing income needs too, like income for that adjustment period after a lost income, while the kids are still dependent long-term income for the surviving spouse, and even their retirement income down the line.
Wow, that's really comprehensive.
It is. And for laughs, they even mention the seat of the pants method, which is basically just picking a number based on feeling, not any real analysis.
Yeah, probably not the best way to make a big financial decision.
Probably not.
Okay, so we've covered figuring out the right amount. Now let's get into how people actually use life insurance in their personal lives.
Okay.
The chapter lists a bunch of uses that go beyond just that death benefit for survivors.
It really does show how versatile it can be. We talked about final expenses like funeral costs, but it's much broader than that. Life insurance can be huge for protecting and preserving your estate, making sure your heirs don't have to sell off valuable stuff, maybe at a loss, to cover things like estate taxes. It's that essential safety net for your family, replacing your income if you're gone, so they can maintain their lifestyle.
Right.
We mentioned paying for education. And it can also be used strategically to pay off big debts, like the mortgage, giving your loved ones peace of mind. And some of these uses actually benefit you while you're still alive.
Yeah, that's what's interesting to me.
Right, like using it to add to your retirement income, especially through the cash value growth in certain policies. It can also be a big help with charitable giving. There are potential tax benefits, both for transferring an existing whole life policy to a charity or buying a new one with the charity as the owner and beneficiary.
Okay.
And some policies can even help with disability, illness, or emergencies through things like policy loans or withdrawals. But you got to understand how that might affect the death benefit and cash value.
Right. Always good to read the fine print.
Always. And finally, that cash value that builds up in some policies can act as a way to save and have some liquidity over time.
It's like creating an instant estate, as the chapter calls it. But they also mention that the value of the policy is usually included in your estate for taxes.
Right.
Important to remember for estate planning.
Definitely.
All right, let's switch gears now and talk about how businesses use life insurance. This feels like a whole different ballgame.
It is. The source starts by saying even the policy loans themselves can be helpful for different business needs, like funding buy-sell agreements, deferred compensation plans, or those split-dollar arrangements we'll get into later. But one of the biggest uses is key employee life insurance, sometimes called key person insurance.
Okay, so break that down for me. What is key employee insurance and why would a business need it?
The whole idea is to protect the business from the financial hit if a really important employee dies or becomes disabled. Someone with unique skills, specialized knowledge, or those relationships that are crucial to the company's success. Think of it like insurance for losing a major asset, that irreplaceable employee.
Makes sense.
The money from the policy can help with finding and training a replacement, managing any drop in revenue, and keeping the business going without major disruptions.
Right.
And it's important to remember, this type of insurance protects the business. It's not for the owner personally.
Got it. So the business itself takes out the policy and pays for it.
Exactly. It's a classic example of third-party ownership.
Yeah.
The business applies, owns the policy, pays the premiums, and is the beneficiary. And because they have a clear financial interest in that key employee, being around their absence would mean a loss, they have what's called insurable interest.
Okay.
The business has all the rights to the policy, like changing the beneficiary, borrowing against the cash value, or even canceling it. Whole life or universal life are common for this because of the cash value potential. But term life can be cheaper if the business just needs short-term protection.
Okay.
Now, the premiums the business pays aren't usually tax deductible, but the death benefit the business gets is usually tax-free.
Okay.
And as long as the employee has no ownership in the policy, the death benefit isn't counted in their estate for taxes either.
It's really about protecting the business from a potentially huge loss.
Exactly.
Now, another big use for businesses is those business continuation plans, specifically buy-sell agreements.
Yes.
This seems super important for what happens to a business if an owner dies.
It is crucial for a smooth transition and continued operations. It doesn't matter if it's a sole proprietorship, a partnership, or a closely held corporation. An owner's death can be really disruptive for the business and for their family. Buy-sell agreements are legally binding, and they lay out exactly how to transfer the deceased owner's part of the business and make sure their survivors are fairly compensated.
Okay.
Life insurance is often the main way these agreements are funded because it provides the cash right when it's needed.
So life insurance is basically the funding to buy out the deceased owner's share.
Exactly. Let's look at how it usually works for different types of businesses, starting with sole proprietorships.
Okay.
The chapter says for a sole proprietorship, it's a two-step process. First, there needs to be a buy-sell agreement where someone, usually a key employee, agrees to buy the business when the owner dies, and the price is set in advance. Then that employee gets a life insurance policy on the owner. The employee owns it, pays for it, and is the beneficiary. When the owner dies, the money goes to the employee who uses it to buy the business from the estate.
Seems pretty straightforward. And what about partnerships?
Yeah.
The chapter mentions a partner dying can actually legally end the partnership.
It does.
That sounds messy.
It can be. Without a plan, the remaining partners usually have to close up shop, sell everything, and split the money, which might not be fair to the deceased partner's family.
Yeah.
A buy-sell agreement, funded by life insurance, prevents that.
Mm-hmm.
It makes the surviving partners buy the deceased partner's share at a price they all agreed on beforehand. And it makes the deceased partner's estate sell. So the business keeps running smoothly and the family gets a fair payout.
Okay.
There are two main types of these agreements for partnerships: entity plans and cross-purchase plans.
What's the difference?
In an entity plan, the partnership itself is the one buying the deceased partner's share. To do this, the partnership buys, owns, and pays for a life insurance policy on each partner. If there are 3 partners, there are 3 policies, one on each. When a partner dies, the partnership gets the money and uses it to buy that partner's share from their estate. And a cross-purchase plan is between the individual partners. Each partner buys, owns, and pays for policies on all the other partners. So with 3 partners, you'd have 6 policies total. Each partner owns 2 policies on the other 2. When a partner dies, the surviving partners get the money and use it to directly buy the deceased partner's share.
I see.
The chapter does say cross-purchase plans can get complicated, especially with more partners, because of all the policies involved.
Yeah, that makes sense. Keeping track of all that would be a headache.
Definitely.
Now, what about closely held corporations?
Yeah.
They're legally separate from the owners, right?
That's right.
How do buy-sell agreements work for them?
The basic ideas are the same: smooth transfer of ownership and making sure the deceased shareholder's family gets paid. And again, life insurance is often used. An entity plan for a corporation is called a stock redemption plan. The corporation buys, owns, and pays for policies on each major stockholder. When the stockholder dies, the corporation gets the money and uses it to buy back that stockholder's shares from their estate. A cross-purchase plan for a corporation works just like the one for partnerships. Each stockholder buys policies on the others and uses the death benefit to buy the shares directly. The chapter also mentions something called a Section 303 redemption. This can help estates that have a lot of closely held stock and are facing big estate taxes.
Mm-hmm.
If the stock makes up at least 35% of the deceased's adjusted gross estate, Section 303 lets the corporation buy back some of the stock to cover those taxes and funeral costs without it being treated as taxable income.
Interesting. So there are options for all kinds of businesses to plan for the unexpected and be fair to everyone involved.
Absolutely.
All right, last but not least, let's talk about how life insurance and annuities are used in employee benefit plans.
Okay.
It seems like another major area where they come into play.
It is. The chapter covers a few key ways they're used. One is funding deferred compensation plans. These are arrangements where part of an executive's pay is earned 1 year but not paid out until later, like at retirement or if they become disabled. They're usually non-qualified plans, so they don't have the same immediate tax benefits as 401ks and such.
Right.
Employers might informally fund these future payments by investing in cash value life insurance or annuities, where the cash value growth can help cover the cost down the road.
I see. And salary continuation plans sound similar, but maybe with a different way of funding them.
Yeah, a salary continuation plan is also something the employer pays for, usually for a small group of high-earning executives.
Mm-hmm.
These plans continue all or part of the executive's salary for a certain time if they die, retire, or become disabled. And unlike some other benefit plans, these are often funded directly from the company's money. And if they're only for a select group of management or high earners, they're usually exempt from most of the ERISA requirements.
Yeah.
That's the Employee Retirement Income Security Act.
Got it. Then there's corporate-owned life insurance, or COLI.
Right.
We talked about key employee insurance earlier. How is COLI different?
CLI is similar in that the company buys, owns, and is the beneficiary of a life insurance policy on an employee. But with CLI, the company might be able to deduct the premiums as a business expense, though there are limits on how much of the death benefit is tax-free. For policies issued after a certain date, it's usually capped at about $50,000 per employee.
Okay.
And a nice feature some insurers offer now with CLI is a change of insured provision. This lets the company switch which employee is covered without having to cancel the old policy and buy a new one. Makes things much easier when a key employee leaves or retires.
Yeah, that sounds really practical.
It is.
Now, what about corporate-owned annuities? How do the taxes work compared to if an individual buys an annuity?
The main difference is how the interest is taxed. With a regular annuity, the interest grows tax deferred until you take it out. But if a corporation owns the annuity and names itself as the beneficiary, the interest is usually taxable as regular income the year it's earned. There are some exceptions, though, like if the corporation is holding it for an actual person or if it's part of a qualified retirement plan.
So it depends on the specifics.
It does. Then there are executive bonus plans, sometimes called Section 162 bonus plans.
Yeah.
With these, the employer gives a bonus to a specific employee, and the employee uses it to buy and pay for their own life insurance policy. The employer can deduct the bonus, and the employee has to pay taxes on it. But the good thing is the death benefit from the policy goes to the beneficiaries tax-free.
So it's a way to help an employee get life insurance with tax breaks for both sides.
Exactly. And finally, the chapter talks about split dollar plans, or SDPs.
Okay.
These are arrangements between the employer and employee, usually using whole life or cash value policies. They split the death benefit, often the cash value, and sometimes even the premiums, based on an agreement they make. It can be good for employees who can't afford as much coverage on their own, and lets employers offer this perk to certain employees.
So it's a win-win.
In many ways, it is. So as you can see, life insurance is far more than just a death benefit. It can be used in so many ways for personal finances, business planning, and employee benefits. We've gone through everything from how to figure out the right amount of coverage to all the different ways it's used by individuals and businesses, and even its role in things like deferred compensation executive bonuses and those split dollar plans.
It's really amazing how versatile it is.
It is. And all this information raises a really important question for you, our listener. Thinking about all these different uses we've discussed today, from protecting your family to making sure a business can keep going or offering great benefits to your employees, how might these apply to your own situation?
That's a great question.
It's worth thinking about life insurance in a new light and seeing if it could be a useful tool in areas you might not have considered before.
Definitely food for thought. Well, thanks so much for taking this deep dive with us into this really fascinating topic. Until next time.
My pleasure.